Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Stephen Yu of Blue Whale, one of the world's finest investment houses. So welcome, Stephen.
Thank you, Paul.
Yeah, well, given all the sort of the investor angst of late over persistently high inflation, rising interest rates, central bank tightening, the ongoing war in Ukraine, and more recently, actually, the sort of tech fallout, the trade dispute between the US and China. What's your sort of like broad outlook for equities going forward?
Yeah, this is a very good question to kick off the conversation. I think there are many things that's been going on since late last year and in particular this year recently as well. But I think it's important that when we look back at the beginning of this year, it was mostly about inflation and interest rate narrative. Of course, we are still in the middle of that cycle, like interest rate continue to go up in the US. But then equally, we recognize that there's some fundamental shift in terms of the world landscape, in particular, what the geopolitics in Europe and also the geopolitics in Asia. And I think there's a lot of things that is going to be more long lasting than being cyclical, because per our perspective, interest rate or inflation is something cyclical over time. When we go into a deeper recession, when unemployment rate start to go up, then you will expect interest rate to stop going up and maybe it will start trending downwards again. So it does go in a cycle. But I think what is important to recognize as an investor in the next 5 years compared to the last 5 years that we have been around, that there's some fundamental shift that we need to recognize. And of course, then it would churn out new opportunities and also things that have done very well in the last few years that might no longer do as well in the next few years.
Well, we've got the S&P down. It's sort of like come from, it's down, I think it's over 20% so far this year. It's trading at around about 3,600 currently. And I think it's seen multiple compression from about, I think it was 18 and a half times PE pre-pandemic. It topped out last year at about 21, 22. It's now at about 16 times, depending on what your forward earning EPS is. Where do you see the S&P trending or tracking over the next sort of like 12 months? Because most, or the smart money seems to be there's the downside for the next 6, but then in 12 months time, it could be rebounding. What's your sort of like your view?
It's a difficult one because obviously you're talking about trading in terms of trading the market as a whole rather than talking about company specific, which is what we do. I think on a very high level that we do believe share price or maybe the S&P index level would reflect the underlying fundamentals of the composition. So when we say underlying fundamentals, we are literally referring to the earnings growth trajectory of a company or the composition of the S&P 500 index. And I think I'll give you one example, which is probably relevant, but maybe not exactly the same, is Microsoft. So Microsoft has been one of the top 10 holdings in the fund. We still like it. But if you look at the share price reaction over the last 6 months or year to date, that is down about 30%. So it's a bit more than the S&P 500 index. And at the same time, we do track the underlying fundamentals that we build financial model, we make forecasts. But if you just look at the share price performance since 2017, when we started the fund, versus the earnings growth trajectory for Microsoft based on Bloomberg consensus, that both of them, despite the 30% reset in share price, both of them have gone up over 250%. So basically, if you look at how much more money Microsoft has made in the last 5 years, that has gone up 2 times more than that, and the share price has gone up more than 2 times. So despite that, there was a bit of a reset in valuation, which is about 30%, being 30% cheaper for Microsoft. I think the fundamental remain quite strong. So I think to answer your question is, I think in terms of the S&P 500 index, it's a bit more difficult to take a view because it's a mixture of many different sectors. You have banks, you have energies, you have some highly indebted companies, you have some retailers, and you have some technology companies, which you still need to be quite selective. Then the question is, how much do you think the underlying constituents would be able to grow the earnings in the next few years? So I think in terms of the headwind for a lot of the companies in the bigger index, then you might expect that number would be a bit lower compared to before. So right. so hence it's a difficult one that you say, oh, is that cheaper now compared to before? Yes, I think the answer is yes, it's cheaper, but it's probably going to grow a bit slower. So which means that the level of return that you get in the next few years could be a bit lower compared to the last 4 years before what happened recently.
Okay, well, let's just look at a bit more granular then. So just briefly on Microsoft, I think everybody's pretty much familiar with the story. It's a sort of like a tech giant that dominates the PC landscape, gaming, and increasingly the hyperscale sort of hosting with its Azure platform. So given it's got that huge sort of like underlying security and barriers to entry and pricing power, I think the actual margins, I was looking at it actually, I think the operating margins are 42%. So it's very profitable. It just shows you the dominant. What sort of price what sort of multiple would you pay? Because it's trading at around about sort of 23, 24 times next 12 months sort of earnings. How do you translate that into sort of like a peg, and how much do you translate that into a premium you're prepared to pay above the market?
Yeah, so I probably have to take you into slightly how we go about valuation at Blue Whale. So firstly, we don't just look at a shorter term valuation, which is a bit more tricky. That a lot of these things are already been priced in. If you look at the PEG ratio in the next 1 to 2 years, etc. I think there are two ways to go about valuation, which is what we do. One is you take a medium forecast in terms of how much more money Microsoft would make in the next few years, and you try to square that with some sort of like free cash flow yield adjusted for that, and see whether that looks attractive relative to the market a few years from today. And I think one thing that investors need to remember is the quality of Microsoft business model is very high relative to the rest of the market, because of the business model being subscription, recurring revenue streams, switching costs being very high, dominant position, etc. So theoretically, I think it's fair to assume that for something that's so high quality, there's always a premium that you pay relative to some other sectors that are lower quality or company that are in less dominant position. And so I think to us, I think Microsoft in today's context is presenting very attractive valuation if you can look out for the next few years. And then secondly, which is what we do over the shorter term time horizon, over the next, let's say, up to 3 years, is we would compare our forecast in terms of how much money Microsoft would make versus the consensus. So versus what the market already have expected. And I think you might recall that Microsoft announced that they're going to raise prices by about 15 to 20% last year. Mm-hmm. And that number have only come into play from April this year. So a few months ago, if you subscribe to Office 365 last year in April, then you would have been paying 15 to 20% more this April. And let's say if you have subscribed to that package in December this year, then in a few months' time, you will be paying 15 to 20% more. But of course, because the diversity of Microsoft customers that typically, I think you go through like a 2-year cycle, like some enterprises might have a 2-year contract, maybe for the smaller company might have a 1-year contract. And if we compare our forecast for how much money Microsoft would make in the next 1 to 2 years, we are actually ahead of the consensus. So despite the fact that I outlined earlier that the earnings growth trajectory for Microsoft is very solid, that's only based on the market consensus. In our own numbers, that we actually have that marginally higher than that number. So I think if you believe, which we do, that Microsoft can beat earnings expectations despite all this headwind in the next couple of quarters, then yeah, I think the shares would react positively on the back of that.
And how would you reflect that into sort of the dominance and the sort of like the defensive qualities and the growth of Microsoft in the sort of cost to capital? Because I mean, typically, I don't know, a big sort of like, fund manager may have an average cost to capital of 8 to 10% that it wants as a hurdle rate for all its investments when it looks at cost for something like a premium product mega tech firm like Microsoft. What would you use for? Would you use the same, or would you use lower, or?
I think you can argue both ways. I think given the quality, you probably can use a lower rate compared to the generic S&P, right? Because to us, I think if you look at the gross margin of Microsoft, which is close to 70%, which means that inflation is not an issue for them. Only 30% of their revenue are paid to external suppliers, 70% they kept in-house. And of course, you mentioned the operating margins over 40%. I mean, the S&P 500 index operating margin is not 40%, right? So that would be a lot lower. So, and then you look at the balance sheet of Microsoft is net cash versus the S&P is marginally in debt. And at the same time, the return on investor capital profile of Microsoft versus the S&P is a lot higher. So theoretically, if you put a number on the market to say this is an equity premium, let's say, I don't know, 8 to 10%, then Microsoft would be lower. It's just mathematical that the beta should be lower. The other thing that I want to flag that in terms of the quality of the revenue growth stream in the next few years is like we have made some conservative assumption that we think Microsoft could continue to grow its free cash flow by about 15% a year in the next few years. So 15%, of course, is a lot higher than the market per se. I think the market you would expect maybe close to 10%. So if you have a company that can consistently do that, then over time we do expect the share price to reflect the underlying fundamentals of the company, which is how much more money they would make in the next few years. So I think I've got asked about this recently by some investors that how is Microsoft going to recover the 30% reset in valuation or in share price terms? I think there are many ways. I think firstly, maybe if the interest rate trend back downwards, then you make it up, you make back that losses in a very short space of time. Okay, no one is expecting that to happen. But then let's assuming that the interest rate expectation doesn't go up more. So let's say it stopped at 4 to 5% in the US, but doesn't go up to 6 to 7 or 8 to 9, just cap that, and Microsoft is down 30, then it takes about 2 years to get back that money. But theoretically, it would be a lot shorter than that because the market would then expect there will be a change of dynamics, etc. So maybe about 18 months that you get back that 30%. I mean, based on our assumptions.
Okay. Yeah. Well, I mean, it takes a brave man to bet against Microsoft. I remember sort of like 15, 20 years ago to trade at $15. So at sort of like over $200 per share. It's not a bad return over a long-term period. Now, that must move into sort of like a different sector, which has really been in the eye of the storm, is the semis and sort of chips. And I did see you've got sort of like a couple of large positions in the chip equipment makers. We've got AMSL and Lam Research, and we've also got the sort of the blue ribbon poster child of chip design, which is NVIDIA. Let's just go through the sort of equipment chip manufacturers, because I'm guessing that obviously the trade war and the reshoring into the US is the trade war between the US and China and the reshoring to the US and obviously chip security is going to play quite a big part in that whole sort of dynamic of the sector going forward.
Yes, correct. So if I just kick off with the semiconductor equipment like ASML and Lam Research, I think you're right to point out that it's all about the reshoring opportunities and also the silicon sovereignty in terms of the Western countries. We would need to have this capability in the next many years compared to before that we are just overly dependent on Taiwan, which is TSMC. And of course, given what's going on in Asia Pac in terms of what China is trying to do in there, that create a lot of uncertainty. And I think even if you go back in time, back to maybe 20 years ago when we had the Iraq war, I mean, that's such a long time ago now, it's all about the oil, right? It's all about energy, it's all about oil reserve and all that stuff. And of course, Middle East being the OPEC, including Iraq at the time, it is important that you have a foothold in terms of the Western country, which at the time was the US. Of course, that might be other objective in terms of what George Bush was trying to do in Iraq, etc. But then I think the simple one is like you want to have a foothold in terms of to secure the energy supply. And I think in today's world, of course, energy remain quite important. I think we have seen that since Russia has gone into Ukraine. But I think what is equally more important is the semiconductors capability. You're talking about everything that get power in terms of your smartphone, your PCs, even like hyperscale data center and all this new cars being produced. Like you do need to have a lot of semiconductors. And let's say if that kind of supply being stopped or no longer in place, I think the world come to a halt. I think it's probably going to be a lot more severe than we have less energy, because energy is a global I mean, the supply is global, even though there's a bit constrained, but you do have Middle East, you do have like Latin America, you do have like Canada, you do have the US and all that stuff. So semiconductor is something is very sensitive. So I think on the back of all these, in terms of what the US is trying to do, because they announced something more measures on Friday last week, about banning some export to Chinese company in terms of semiconductors capability is all the same in terms of narrative, in terms of the CHIPS Act, and you can expect that in the next 3 to 5 years, we would have a lot of this back to the Western world. And of course, some of these semiconductor companies are going through a journey now because we are in the middle of a recession. So hence a lot of things that they were used to power, they are selling a lot less now. So smartphone is going to be down, PC is going to be down, or even gaming and all that, they're going to be down a lot more compared to before, or compared to when we had after the pandemic reopening. But I think over time, we would expect the structural growth drivers from the reshoring opportunities in the Western world would compensate a lot, would offset a lot of those decreases, which which probably would make those companies a lot relatively higher quality compared to before. Because I think one thing with semiconductors, which is what the market is trying to gauge where they're sitting, and that is different to our investment thesis, is of course, I think if you look back in maybe 5 to 10 years, semiconductors company are always very cyclical because it's all about consumer gadgets, anything that's consumer related. But now, if you look at NVDA, I think in the recent quarter, if you analyze that, it's close to 70% of the revenue is selling into the hyperscale data center and also the auto space, which means that in time that would be a lot more high quality, a lot more recurring. That's no longer just depending on whether some gadgets are going to be sold more to consumers compared to before.
And just on valuation, and we're just running through the three. You've got NVIDIA roughly around about 30, 31 times. You've got Lam Research, which is obviously equipment rather than a chip designer, on about 11 times, and then you've got AMSL on 19. I mean, what would you say out of the three is offering the sort of the best value at that time, at that place? Because I mean, obviously it's a variable on the quality, the dominance, the sort of competitive position, and the long-term economics.
Yeah, I think it's a difficult one. Of course, I mean, we like three of those companies, and hence they are all on our top 10. But I think they do offer something very different. So I think if we just kick off with ASML, I think because the EUV machine that ASML produces is very high end, that no one basically have that technology.
They're $200 million machines,
correct?
Lithography or something. Yeah,
correct. So they are extremely like high tech stuff. I mean, you're talking about like a fighter jet or whatever. Like it's very high end stuff. Like no one can do that. And of course, when you're producing such a level of tech, like in terms of the order book and the lead time, it takes a long time to place the order, and by the time you get the product, it's going to be like 12 to 18 months. So in terms of the quality of the order book is very, very much in place, as in like there's not a lot of concern, because like a lot of order being placed is going to be delivered, and then you already have done the prepayment and other stuff, and hence the quality is a lot higher than, let's say, Lam Research, which is trading at 11 times, as you mentioned, versus 19. I think I think going into Lam Research is because it's such a lowly rated stock, and I think if you look at the balance sheet of Lam, at the same time they're doing a lot of buybacks. So they're spending like 10 to 15% of the market cap, like buying back stocks in the next couple of quarters, and that could drive returns in terms of financial return. I mean, you're basically buying something back at 11 times, and over time, if the business recover from its trough, then I think the value that we get from as a shareholder is going to worth a lot more than, let's say, maybe ASM will just continue to deliver the earnings, but they don't have the firepower to buy back as many stocks as like Lam Research does. I think NVIDIA is a very different one. Is definitely one of my favorite stocks. I think this year is probably not the good time because the shares has gone down just about maybe 50%. So I think this time is the wrong time. I mean, NVIDIA is still a $300 billion company. I think if you ask me to make a bet, what NVIDIA is going to do in the next 3 to 5 years, I think NVIDIA could easily become a $1 trillion company, just based on how much we need the GPUs that they produce in terms of hyperscale data center and also in auto space. And there's a lot of like artificial intelligence in the industrial space in terms of automation. There's a lot of things that's going on, which NVIDIA has proven to be kind of the company to go to supply those GPUs. And of course, I mean, if NVIDIA could become a $1 trillion company, I think the return would be quite a lot. But the challenge at the moment is all these three companies, they are going through a bit of like a difficult times, just because the macro is a bit uncertain. Like, I mean, going back to what the US is trying to do to ban the export to China, which would have impacted some of these names over the short term, but to us is all part of the same narrative. Is exactly why we are reshoring those capabilities. Exactly why in the US they have the CHIPS Act. In the Europe we have something equivalent, which is also about 50 billion euros to subsidize all these chip makers. Hence, they are coming back here. So banning the Chinese, kind of exporting to Chinese companies is the same thing. Like if they are not going to ban Chinese company from having all this technology, then why are they subsidizing all this reshoring opportunity? So it's kind of reinforced. But of course, I mean, shorter term, they would get impacted on the numbers because that development in terms of building new fabs take a bit of time rather than it's like in 1 or 2 quarters.
Yeah, no, I can absolutely understand that, you know, with the chip sector being first into the downturn, it's been absolutely taken out to the woodshed, and it should be the first on economic upturn coming out of it, no doubt about it. And with such strong operating margins and attractive growth, secular growth tailwinds longer term, then it's really stick with the GARP stocks, because if you've suffered the pain at the moment, you might as well stick with it, because they've got so much potential upside. And I must admit, I would agree with you. I think something like NVIDIA could be another Microsoft, no doubt about it, you know, well over $1 trillion in about the next 10 years. Now, you've got obviously a few cyclical plays in the sort of the chips, but you've also balanced that with some quite defensive plays. You've got the payments giants, Mastercard and Visa, which I think have the highest operating margins I've ever seen at sort of 60 to 70%, because they're just so, you know, dominant around the world for every sort of payment process. Particularly, I mean, as a consumer, you know, that touch pay, you know, where you just basically put your credit card over one of those the ATM machines, then and you get you pay for it. It's just so quick and easy.
Yes, I think the Mastercard and Visa is something that we do like in the current regime in terms of the inflationary environment. I think one thing that some people don't really understand what they do is probably have make them look less attractive. I think if you really know what they're trying to achieve, is they basically charge a commission fee in terms of nominal spend by consumers or businesses. So it doesn't matter whether you use a credit card or debit card, as long as it's a card that's issued by your bank that you have the Mastercard and Visa logo on it, then they would pay a commission. And we do think like Mastercard and Visa are the best hedgers in terms of inflation narrative. So let's say in the UK that we are experiencing about maybe 10% inflation, of course, across different spectrum. But then let's say if we do still go outside to the restaurant, we go to maybe to an event, we go traveling, etc., we are paying 10% higher compared to before. And of course, from Mastercard and Visa perspective, they would make 10% more compared to, let's say, this time last year. And also equally, exactly the reason that they are making such a high level of operating margin is because they are technology power, that they don't need to add more people in terms of servicing the network, the payment network they have built over the last many years. And I think the thing about this kind of this dynamic is, under GICS definition, so there are many kind of sector classification, but under GICS, they are actually categorized as technology company. Like to us, they are categorized as financial services, because it's all about payment technology, but it's payment processing in terms of where payments going and circulate within the banking network. But I think you can put it together that, yeah, they are kind of financial services, but purely powered by tech. And hence, like they do make a very high operating margin, and you're right that not only that the business model in itself is inflation proof, because the operating margin is very high, or the gross margin is almost like 100% or 90%. At the same time, on the other side of the coin, that they would make more money on the back of inflation. So you believe that inflation is going to stay high for the next few years, they would continue to make more money, despite consumer spending might come back down. But then I think what we have evidence since the global financial crisis 15 years ago is consumer spending never go down that much. I mean, overall, I think consumer spending in the US would go down a few percent, even despite in 2009. But what happened was like we reorientate our spending from one place to another. So of course now, given the kind of our disposable income being squeezed, that maybe we spend less in restaurant, but then we'll probably spend more in supermarkets to buy the necessities.
No, I'm with you. I mean, I don't own the shares, but I can absolutely see the payments giants. Probably, I mean, what's quite interesting actually is that investors typically hold out the US Treasury as the risk-free asset in the world. But you could equally argue it's Mastercard and Visa, because they've got the currency debasement hedge there. Whereas if you go into US Treasuries, you don't know what the currencies or the gilts, because I mean, look what happened to the gilts 2 or 3 weeks ago. So you could almost price it such that it's actually almost other than regulatory risk, I guess. If somebody, some of the local, like the EU or the UK regulators decide to knock them with duopoly type sort of charges and stuff like that. But other than that, they seem to be sort of the risk-free assets. Now, another area that you sort of like, you've got a reasonable amount of weighting in is healthcare, which again is quite a defensive area. Dexcom, which I understand sort of like does diabetes remote monitoring. And you've also got Sartorius, which I think is a top quality sort of like biologics equipment manufacturer for labs and stuff like that. Do you want to take us through the Dexcom first? Because it seems to be, gathering data in terms of collecting the diabetes, but also, changing the paradigm in terms of people having to sort of prick their fingers and get their diabetes tests.
Yeah, so I think this is one interesting thing about us is like during some period during the pandemic, we have been coined as like a tech fund, like because we do have a few techie names that I think people recognize on our top 10 relative to some of our competitors, and I think we have been probably from a press perspective, we have always been saying, oh, Blue Whale is a tech fund. Blue has done this and all that stuff, but in reality, it's like we are not a tech fund. Like there's certain areas that we do cover, which I think you rightly mentioned is like medical equipment companies, which is a sector that we do follow. And at the moment, I think why Dexcom is quite interesting is what's going on in the US in terms of type A and type B diabetes patient. And I don't know if you saw something happen recently about the Medicare is going to change in terms of how that gets subsidized, so that if you have certain symptoms that you might get subsidized to get the equipment, which will cost you about probably a few $1,000s to get that. And it's going to be helpful. And I think one thing that's been shown is over time that if people, before they get to the very serious symptom of like diabetes, which then it will increase the overall healthcare cost to the state or government, that if you are able to get access to this technology earlier, then you will be able to track your glucose intake. Then maybe it would make you a bit healthier, maybe you're a bit more conscious, etc. Then it actually reduces the overall kind of the burden from the state, and everyone knows is that in the US healthcare spending is the highest in the world per head, and I think there's good reason to this. And I think based on that, I think the dynamics within the Dexcom space diabetes, which is very very sticky, very high quality, and you can work out the TAM market, like in time they could just sell to many more people and expect. And I think the kind of the maybe inflection point would be the state recognize that actually is a good place to give this technology to everyone that needed this, rather than at the very late stage, like maybe you get this being subsidized, but maybe it's just too late already in terms of that process. So Dexcom does have very good technology in that area, so we like that. And I saw actually, just adding to that, I saw the NHS has just adopted it last Friday. It said that actually lock, stock and barrel for diagnosing or not to monitoring type 1 diabetes across the UK, it's going to use the Dexcom device, which just says everything in terms of the quality and exactly what you're saying. I mean, my father has been warned that he could become diabetic. That's the type 2.
But this is the kind of advice that he would use, just make sure that when he does he changes behavior and changes what the foods he eats and his lifestyle, is he making progress? So I'm with you. These kind of things are absolutely life-saving and certainly cost-reducing for the NHS, because you don't need to pump masses of insulin after the event.
I think that's right. And the other thing about Dexcom, the valuation is definitely a lot more expensive than some other names that we have in the fund. But I think because the current market exposure for Dexcom's business is very small. So you're talking about like the TAM, overall TAM could be this big. And at the moment, it's just such a small one. So for Dexcom, it's not in our top 10 position because the company is a bit smaller. But I think if we take a long-term view that you can easily see in the next 5 to 10 years, this company could quadruple or maybe multiply in terms of the end market. And of course, then they would be making a lot more money out of that. But it's going to take a bit of time in terms of the journey to capture the end market.
Yeah. What about Sartorius? Because it obviously it sort of majors on lab equipment, on medical equipment for sort of like biologics. So these are sort of, instead of your classic sort of chemical derived drugs, these are sort of like live living organisms, large molecules, etc., which is growing much faster because you've got the likes of you've had the likes of Amgen and drugs like Humira and all this sort of stuff, and they just become they're far better and sort of less side effects, I understand.
Correct. So Sartorius is one of our top holdings in our fund, and basically, if you follow what happened during the COVID vaccines development, that the reason that we managed to come out with all these vaccines within such a short space of time was based on biologics, and of course Sartorius was involved in that manufacturing process, and I think what has been proven is biologics seems to be the place to do more research, and in terms of development of new drugs, I think that is the way to go from here. And I think if you really look at the composition in terms of the split at the moment, biologics probably account for about maybe less than 50% of the entire drug development market. But
it's about 30%, I think it is.
Yeah, well, or even lower, depending on which area of the market. But in time, we would expect this to continue to trend upwards, just because it's going to work a lot better in terms of how a drug is developed. And at the same time, in terms of Sartorius specifically, what they actually do, or why it make them quite high quality, is because when you have a drug in development, you need to file an application with the FDA to get it approved in terms of a drug. But then also you need to file for an approval in terms of how the drug is being manufactured. So basically, if you have used Sartorius machine to get to the final product, you would need to document exactly what goes into in each stage of the process until you get to the final product. So basically, once a drug has been approved by the FDA, if Sartorius machine has been used in that production kind of cycle, then that Sartorius machine would stay with the drug forever, as long as that drug is being produced. So if that drug is going to last for 10 years, then Sartorius machine will be used for 10 years. Of course, then you would have the replacement, the maintenance, and all these different recurring revenue stream, etc. So it makes Sartorius very high quality or entrenched within that development cycle. So rather than you get a drug and then you replace the machine, you can't actually do that, because once you have done it once, then you have to stick with them for the lifetime of the drug, which makes it quite cool.
Yeah, no, I mean, it's put you on sort of a platform stock, doesn't it? Because you get onto one of these drug programs or the biologic programs, and they might have a life of 20, 25 years because of the patent. So if you're applying them with equipment and consumables, then it's a nice position to be, where you've got excellent revenue visibility. Now, a couple of recent purchases, a slightly different area to sort of the hyper growth that we talked about with the chips and potential long term with the healthcare is the US rails. Now, I don't see you've purchased both Canadian National Railway and Union Pacific Corporation, which are trading around about sort of 15, 17 times PE. What sort of attracts you to those? Because obviously, they're very defensive, to say the least. Is it the reshoring or GDP or what?
Yeah, it's mostly reshoring. So I think this year, when I talk at the beginning, it's about the structural changes that we're going to see in the next few years. I think I think one of those is the globalization. And of course, on the back of the globalization, you're going to expect some reshoring opportunities. I mean, we already talk about semiconductors company, which is a bit more global, because even in Italy, Germany, France, we're going to see some fabrication plants, semiconductors production capability. But I think if you talk about reshoring of industrial activities or production activities, I think one thing has been quite clear is, despite that there's going to be reshoring opportunities away from China into the likes of Vietnam or India, I think the overall reshoring pie in Asia Pac is going to become smaller in the next few years, just because Vietnam and India can't take up that much of the slack. And of course, with the geopolitics, you probably want to take a lot of this production capability back to the Western world. So I think the overall pie is going to be smaller. And then on the back of what happened in Ukraine in terms of energy crisis, you can't expect reshoring opportunity to happen in Germany, for example, in France, because you're going to pay a much higher energy bill to produce certain goods. But I think one thing has been quite clear is the US or North America, because not only that North America is energy self-sufficient, at the same time, in terms of the economy, I think in today's context, relative to the rest of the world, is doing a lot better. Despite, they do have high interest rate, high inflation, which the same as the rest of the world. But in terms of the consumer health, in terms of what's going on in the US, is a lot better. And I think if you are a foreign company trying to sell to the American, and if you haven't got a lot of your production capability in the US, I think now is the time to do it. And at the same time, if you are based in Europe, I think you get probably lower energy bills in the US compared to you're based here and try to ship it over to the US. And I think equally for any American company that's selling domestically, if you have a lot in Asia Pac before, you probably want to take some of that back now. Right. And so then the U.S. railroads, which the two railroads that you mentioned are connecting Canada to the West Coast and also West Coast to the Mexico area. So we do expect there's going to be a lot more industrial activities or production activities in Mexico, which makes sense that then if you have the rail basically connecting that side of the fence, then they would benefit over time. And I think the last point I would mention on this is, I think over the last probably 10, 20 years is always in a developed market or country, in terms of GDP contribution or how GDP is kind of driven, is always on the back of consumer spending. So 2/3 of economy is based on consumer spending, and the other 1/3 is industrial activities or government activities. But I think going forward, we can easily expect, in particular in the US, that industrial activity as a percentage of the GDP is going to grow a lot faster than consumer spending, just because consumer spending is being hit by both interest rate and inflation. So we have less disposable income to contribute to or to spend our way out of this recession. But in terms of the subsidies, in terms of all these geopolitics uncertainty, then you would expect the industrial activity is going to pick up. So the railroads is one of the few names that we have picked up that could benefit in this area, and we continue to look for new ideas in this area.
Right. And just on that sort of bigger picture on the reshoring, I mean, if I was a global manufacturer and I was looking to put some new facilities in play, etc., then if the government was giving me some subsidies, as you talked about with sort of the CHIPS Act and also with the EVs, in terms of giving subsidies to consumers to buy electric vehicles, etc., then that would be a no-brainer. But in terms of if it was a like-for-like process, the only danger I would see is, if I was a CEO, which I'm obviously not, of a large corporate, would be, the dollar's very strong compared to the rest of the world. And therefore, am I sort of like building in an uncompetitive manufacturing base, even if sort of temporarily the energy costs are sort of higher in Europe than they are in the US? What's your sort of thoughts on the sort of currency? Because I mean, the dollar's so strong against every single, sort of like currency, even the Japanese yen.
Yeah. So on the back of what we just discussed, is like another phenomenon is that we recognize is strong dollar, which basically is the global growth that we can talk about that in more details. But so I think it really depends on what you do as a company, right? Like if you are selling into the US, I think typically it makes sense that you have a production base in the US going forward. But of course, it doesn't make sense if you are an American company and you produce in the US and you are selling it to the Far East or maybe selling into Europe. I think you need to go into the nitty-gritty in terms of what you actually do as a business. But of course, yes, you're right to say that yes, strong dollar is going to make, maybe if you have a base in the UK per se, given sterling is very weak, then it costs a lot less. But of course, I mean, you would then have to marry that with other things about what's going on in the UK. Do we have the talents? Do we have the government support in terms of what we're trying to do? And of course, if you're based in the UK, it's very difficult to sell into Europe. So maybe you want to be based not in the UK, but maybe in EU countries and other stuff. And then the other thing about Asia, which is probably more like for the US kind of manufacturing base, is in Asia, everything's priced in dollars. So if you're producing in Asia, I'm not sure whether you get a benefit, like unless you're going into like. Yeah.
Well, it's either that or their margins explode, don't they? I mean, they get one or the other benefit, don't they? If you're a local manufacturer, you either make huge profits in a lower tax location in Asia.
Correct. Yeah. Correct.
And you charge the same prices or you reduce your prices, I guess. There you go. Nice. Okay, so now just another final section, software. Obviously, we talked about sort of like Microsoft, but you seem to sort of like more go towards the B2B, the enterprise, the corporate software rather than sort of consumer. So we've got Intuit, which basically does sort of accounting software and tax filing software, and I think owns also sort of Karma Credit as well. So it does all things sort of like accounting and financials, etc. Largely in the small space, so it competes with the likes of Sage. And then we've got Atlassian and Adobe. So let's kick off with Intuit, because again, it's sort of like a real sort of category killer dominant. It's not cheap, but it's very, very defensive, I guess.
Yeah, so in Intuit, I mean, you're right to point out that we do like many software businesses. I think that have been with the fund since we started. I think at the peak, we even have about maybe a third of the fund in software names, and they are across different industries. Like Intuit would be one of those. And I think one thing that why we like a software company is because of the subscription, because of the stickiness. Like once you're into the ecosystem, it's very difficult for you to get out or to go to a competitors. So the switching cost is very high. So I think that's very common in terms of what software company does. I think in particular for Intuit, I think from our perspective, in today's context, we talk about the global growth. We talk about like the world is very uncertain outside the US. That because of Intuit business is split between the accounting and also the tax filing, and it's about 50-50. And overall for Intuit business is over about 80% of the business is US centric or North America centric. So if you believe that the rest of the world is a lot less certain going forward compared to before, then Intuit is actually relatively well positioned, even versus the likes of Microsoft, because Microsoft is a global business. They do have exposure to Europe, they do have exposure to Asia Pac, and of course, if we have some industries started to shut down or maybe start having some bankruptcy, then Microsoft licenses could be impacted, but Intuit would be less in that space. So Intuit is a company that we actually like a lot, and we have been increasing our exposure over the last few months as well on the back of what we're seeing. I think Atlassian is something different that I think if you ask me, I think Atlassian sit in a very similar spectrum as NVDA. That at the moment is a bit tricky.
It does software for sort of like developers of software writing, doesn't it? So it's sort of like project management teaming to make sure that the whole process is very smooth. About if you wanted to sort of develop the latest apps, etc., then you'd use theirs as a sort of like a de facto software standard.
That's right. So basically, Atlassian's product is probably similar to maybe the Bloomberg and Excel for us as like financial professionals, and the way that goes about it is like if you think about what we need in the next maybe 5 to 10 years, is we definitely need many more software developers just because of all this AI and there's a lot of things going on, metaverse and all that stuff. But at the same time, it's very similar to the Sartorius case, is because software development is done very much in across different teams and with a lot of collaboration. So let's say theoretically, like you and I are working in a sub-segment of a big program, that we are typically just going to be responsible for that part of that program, which might account for maybe 10% or 5% of the program. But of course, everything that we do would have implication for the rest of the program, whether there will be bugs, whether that might make the program crash because it doesn't speak with each other. And so what Atlassian software do, which is called Jira, is you need to log all the changes that you made within the program. So if you and I are trying to make this work and then we'll make certain changes, and then everything needs to be kind of in sync with what has happened in other parts of the program, and all this would be documented, and everyone can then look into your part and say, oh, why is the program not working, or can we make it better? And then maybe then they come to speak with us in terms of the team leader. And so all these are very sticky, like in terms of how this is going to go. So if you do believe that over time software development is here to stay, just because we're heading into this new world, then Atlassian is going to be very powerful in terms of capturing this end market. So to us, Atlassian is a bit like NVDA. So if you look at the share price, it's a bit volatile. I mean, they early this year that they actually announced that they're going to hire more people despite the kind of uncertainty outlook. But I think they are right. I think they're going to take market share in this downturn. And when we come out from this downturn, I think they will be a lot stronger.
Yeah, no, I mean, I could definitely see if you've got a de facto standard and you're becoming the industry play on this, then it's the big get bitter. The big will get bigger and stronger, because if I was a corporate and I had some apps to develop, one of my biggest concerns would be making sure no Tom, Dick, and Harry can put in some changes that one may destabilize the customer base, but more importantly, as we've heard recently, you get a cyber criminal who puts in some sort of like code, sneaks it in, and then you get this real problem in terms of something like Microsoft had and Apple have had, where you've got a huge cybersecurity breach across your whole customer or client base. So you're having to fill that hole patch it up very quickly. So yeah, I mean, I'm with you. My only question would be with Atlassian would be, what price do you pay? Because it's trading at about 17, 18 times sales. So I wouldn't say it's the cheapest stock I've ever seen.
No, it's not the cheapest. I think they I mean, in terms of valuation, they have definitely suffered a lot more this year because of the high interest rate environment. I think, and as far as Atlassian is concerned, it's a bit similar to Dexcom. It's like, if you really look at the potential of the end market, and also at the same time, that in terms of the pricing model that previously, I think the numbers start to come into play now. So you would see that number kind of probably the valuation to come down a bit, is they basically have increased prices by about 10 times. So,
yeah, okay.
So previously they were basically charging like developers maybe $1 to $2 a month, and now they're charging at $10 to $20 a month. So that number has gone up a lot, and that's going to feed through into the valuation or the underlying earnings of the company. So over time that would play out. So they started out being very lowly priced, and they get everyone or the developers to use it, and over time then they realize that actually they have the pricing power, and that they're now raising prices. So that would make the valuation a lot more attractive. And hence I think the reason that we don't look at the shorter term valuation, which is the headline PEG ratio, P ratio, etc., in the next 1 to 2 years, is if you take a medium term view, which is about probably up to 5 years, then you can really then look at the valuation in terms of how the transition is going to take place. I think sometimes in the next 1 to 2 years is very difficult, because we are not just investing in the next 2 years, isn't it? It's about the next 3 to 5 years, and on a rolling basis. And if we can justify the valuation with our forecast, then we would think it's fairly attractive.
Yeah, no, I mean, I think it's an absolute, it's in a perfect sweet spot there. Now, just coming finally then to Adobe, which obviously did really well out the pandemic, selling effectively online e-commerce, m-commerce sort of like software to allow companies to be able to distribute their products when all the shops were shut. So it did really well, and then obviously it suffered, but it's come back now to really less than the Nasdaq. It's on 21 times earnings, forward earnings, which seems incredible for such a category killer and dominant position. Any ideas why it's sold off? And I presume you're holding it because it's too cheap.
Yeah, so I need to give you a bit of tell you a bit of a journey for Adobe's investment thesis. So since we started the fund 5 years ago, Adobe has been a consistent top 10 holding in the fund until March this year. So since March this year, you haven't seen Adobe in our top 10, but it has been with the fund as a top 10 for the last 4.5 years. And the reason that we started to reduce our position in Adobe is because we have been tracking the job postings in terms of how much acceleration they have managed to capture during the pandemic. Of course, I mean, you talk about category killer and all that stuff. And some of that is actually coming down a little bit since we reduced the position. And I think the other thing that we're looking at Adobe now, I mean, Adobe is a small position in the fund now. It's no longer in the top 10. It's just maybe, I think it's a sub 2% position, which is quite small in Adobe's context. Is we are trying to assess the outperformance potential for Adobe in the next 5 years compared to the last 5 years. I think what we had in the last 5 years about the digital transformation in terms of the business model going into the SaaS and subscription on the cloud platform, which wasn't the case before, and is now completed. And then secondly, of course, there's some competition within certain categories like Kana. Recently, they pay a very high price for this Figma collaboration tool, and hence the shares suffer. And at the same time, we are quite cautious about the end market, which is creative professionals, content creation, or even digital advertising. And hence, we exited Google Alphabet a few months ago, which I'm sure some of our investors have read about them. But I think for Adobe, the business model is high quality, but at the same time, it's the uncertainty in terms of where they're heading in the next 5 years is a lot more. So basically, going back to your point on valuation, yes, now Adobe is trading at a lower valuation compared to many of the points in time over the last 5 years. But I think the outlook is less promising.
Right.
So they would survive, they would do well, they probably would still do better than the market because the business model is high quality. But I think the level of outperformance potential you would expect from Adobe now in the next 5 years would be a lot less compared to the last 5 years. So then the question from our perspective, because we only try to invest into 25 to 35 company at the moment, it's 25, then it's all about competing for place in the fund, isn't it? I mean, we talk about NVDA, we talk about Atlassian, we talk about Dexcom, or even Sartorius, and we think like in the next 5 years, they would be a lot bigger. But for Adobe, I think at best, they would still grow, but then they are not going to be significantly bigger compared to what they did in the last 5 years. So I think that's our view on this. So we are reassessing the outlook for Adobe in terms of today's valuation, but at the moment, we haven't actually pulled a trigger yet to either to buy more or maybe to sell more. So I think that is just a conversation we're having at the moment.
Unless somebody like Amazon buys them, which might change.
It's always rumored that Microsoft would be interested. So that would be a bit different.
Yeah. Okay. So just coming full circle, then it sounds as though you're probably sort of like looking at a number of areas going forward. What sort of like sectors are you sort of like watching out for your next sort of like seeding some capital, or are you just looking to sort of like add to your existing positions?
Yeah, so at the moment that we have done a lot of work into the energy space. This is something fairly new to the fund or in the context of what we have done in the past. I think one thing that strikes us about the energy space, I'm sure our investors have followed that very closely, it's not so much about the demand cycle. I mean, we're in a recession now. Of course, I mean, the oil prices suffer. But I think if you look at the supply side of the oil and energy market, is we can easily argue that the oil price could be well supported at a high level compared to before, despite a recession. And that's on the back of the geopolitics, not just in Ukraine with what Russia is doing, but at the same time, the geopolitics between deteriorating relationship between Saudi Arabia and the US, which wasn't the case before. And then last but not least, in terms of a potential disruptors many years ago about the shale gas or shale oil in the US, that's no longer deemed as a disruption because the depletion rate is very high in terms of all those rates that is about 25% of that rate is going to be depleted every year. So it's actually not a threat anymore. And then, of course, then you look at everything else in terms of the energy transition. I think with the energy crisis, that energy transition is going to be a bit more slow burn compared to before, just because that we don't actually have alternative. And hence, what it means if you can find a energy company that have a very low production base with a long life of reserve, and they can easily make up quite a big margin in terms of, let's say, the oil price being supported at maybe $70 to $80. and their production cost would be lower than 50, and then they can easily make this free cash flow on a very sustained basis, sustained level or period over the next many years. And of course, then you look at the balance sheet of some of this company, they are quite healthy now just because the oil price was very strong at the beginning of the year. And so what you would expect from them is you're going to expect a lot of either higher dividends or maybe more share buybacks if they're a US company. And of course, that drives the financial return for shareholders. So one thing that we have always said is we don't forecast the oil price. We don't think we can forecast the oil price. But I think for some of this energy company is you don't have to forecast the oil price to go up to 100 or 150 to make money. I think at the moment, it seems like maybe the landscape in itself is presenting a very good opportunity to make money in the energy space. And I think this is one thing that I said at the beginning, is like, in the last 5 years, why would we be interested in the likes of the railroads, energy company, or even Charles Schwab, which we had it on our top 10, is we would rather to have like Amazon, PayPal, Facebook, or Google in the last 5 years, because that would be the best opportunity to capture. But I think certain things have changed in terms of dynamic. And in the next 5 years, I think even including the likes of Adobe, that the outlook profile is less promising than before. But then certain opportunities or new pockets have come up, such as the energy, such as the railroads, and we can definitely see that they're going to take a bigger share of the world GDP in the next 5 years compared to the last 5 to 10 years. So energy is a new area.
Okay, brilliant. Well, it looks like you're probably putting your slide rule over something like Chevron or EQT or something like that out in the States. But anyway, we've got you. You've whet my appetite there. I'll hold it with bated breath in terms of what you finally decide to invest. So thanks very much, Stephen, for your time. Excellent insights, and we've had a whirlwind of a number of really good, attractive, long-term sort of like secular growth areas. So gives plenty of ideas for investors to pick over. In terms of putting some money into Blue Whale, how best to do that, Stephen? Is it through your broker or through your IFA, or even contact yourself? I don't know. Yeah,
there are many ways to invest into our fund. So if people have come onto the website, you can actually do it directly through our website, bluewhale.co.uk. But if you're already a customer of some of the DIY platforms like Hargreaves Lansdown, AJ Bell, Interactive Investors, then you can find our fund there as well. So you should be able to buy our fund through different platforms, or if not, come to us directly.
Brilliant. Okay, well, thanks very much for your time, and look forward in touching base probably in about sort of like 6 months' time. So thanks, Stephen.
Thank you, Paul.